Hello, everyone. My name is Shay Smith. I'm your loan officer here at New American Funding, and this is our Home Buyers Workshop brought to you by Shay Smith and Zandria Garay, your go-to realtor, me, your go-to loan officer. Thank you so much for tuning in. I promise that my camera's a little blurry. Sorry about that. Is that better? So I promise I won't take too much of your time. I understand that time is valuable, your time, my time, our time. So we're going to be as quick and efficient as possible while we're getting to all the goodies that we can during this exciting transaction for you. Let's go ahead and get started. All right, so what is our mission? Our mission is to educate the community and first-time homeowners. We want to make sure that you're taking the right steps in order to get you into your home. With that being said, let's go ahead and get into an overview of what we're going to discuss. So today we're going to discuss credit requirements for home ownership, income requirements, assets, meaning like sources of assets that we can use, eligible income sources, not all income is eligible, how much you should put down for your house, how much home you can afford, even some down payment assistance. Again, save your questions till the end. That's where we'll get into the common questions. And if there's anything that I don't discuss, you can always let me know as well at the end. Thank you. All right, so yes, this is as casual as we want it to be. The first thing, like I said, we're going to discuss is credit requirements. Now, credit depends on the loan type. There's a couple of different types of loan. We're going to discuss just a couple in this slide. FHA loan. An FHA loan is typically for someone who doesn't have the highest credit score and doesn't have the most money to put down. With an FHA loan, you can get approved with as little as 580 credit score. Now, when I go over the down payment, keep in mind this is very generic. Everybody's situation is going to be a little bit different depending on your credit profile, whether or not you have any liens, judgments, collections, and things like that. But typically speaking, when you have a lower credit score of 580, you can get approved with as little as 10% down. If you're pretty fair at a 600, you could get approved with 5% down. And when you have a 620 credit score, you can get approved with as little as 3.5% down. Now we're talking Inland Empire, Los Angeles, Southern California. So typically, those houses are running anywhere from, I would say on the low end, about 480. If you're a little deeper in the Inland Empire, you might find something in the 400 range if we're looking at condos. And then typically the single family homes are starting anywhere from like 500 and they're going into the high 800s. The Inland Empire, if we're talking about Orange County, they start at about 700 to 800. So when I speak of down payment, you got to think about the purchase price as well. So 580, 10%, 600, 5%, 620, 3.5%. Now, conventional loan, however, is going to be beneficial if your credit score is a little bit higher. Typically, you want to have a 640 or above. And in this market, you want to have a conventional loan because it's a seller's market. So basically, that means that you're getting there's going to be a ton of offers being put in. If a buyer is looking at, or excuse me, if a seller is looking at a conventional versus a FHA offer, the conventional shows that this person has higher credit score, so it's probably going to be an easier approval. Now, I'm not saying that you can't get your offer accepted with an FHA because you most certainly can, especially with the way we do your approvals. They're pre-approvals, meaning everything's fully underwritten when your offer's put on the table. So that's one thing. You can always get approved with FHA. It's not a problem, especially if you have a realtor like Zandria who knows what they're doing. They can always get your offer accepted. So back into what I was saying, conventional with a 640, we're looking at anywhere between 10 to 20% down. If you're at a 680, we're looking at approval with anywhere between 5 to 10% down. And then with the 720 conventional, you can actually get approved with as little as 3% down. So typically people say 3.5. Conventional goes as low as 3% if you have good credit. So keep that in mind. The next loan we're going to talk about is a VA. And if you don't know what a VA loan is, it's for all you veterans out there, and y'all have it good, because you don't have to put any money down. There's some really great programs out there for veterans, and you can go as low as a 500 credit score. I forgot to put that on the slide, but definitely 500 credit score. Great products, no money down. Just keep in mind, the less you put down, the higher your monthly payment's going to be. So as a lender, my job is to make sure that we can find that the middle ground where your payment's not too high, you're comfortable, your debt to income, things like that. Finally, we offer down payment assistance. Now, a lot of people may confuse down payment assistance with no money down. Down payment assistance is a portion of your down payment. So let's just say, for example, one that we use a lot is called Cal HFA, and with that one you can get up to $11,000 towards your down payment. Now, if we're talking about a $500,000 house, $11,000 isn't going to be your full down payment. So you still have to have money aside for some down payment, and you still have to have some money aside for closing costs. Closing costs could roughly cost you about $5,000, $6,000. It all depends on your specific situation, location, and things like that. We're going to go ahead and go to the next slide. So now I want to talk about income requirements. In general, as a lender, what I need to see is 2 years of consistent employment history. Now, again, as I mentioned before, this is very general. There are certain situations, if you had 1 year and then you were laid off due to like COVID, of course, we can make certain exceptions, but generally speaking, we want to see 2 years of consistent employment history. If you're self-employed, same thing. You can't be employed 1 year and then self-employed the next. We need to see 2 years of consistency. Another thing with self-employed borrowers, if you're looking to purchase a house, I understand that we don't want to pay taxes. None of us do. I pay a ton of taxes. We all do. When you're trying to buy a house, avoid your write-offs, because we look at your net income when you're self-employed. So that means your income after your deductions. If you're claiming a loss, a negative, or if you're barely claiming any income, then it's going to be hard to get an approval. Now, we do have other loan products where we can use bank statements, but typically those are going to have a higher interest rate, and you don't want to have a high interest rate, especially with your first home. The next thing I wanted to discuss is your housing expense. So when we're looking at your income, we look at something called your debt compared to your income. So that's the amount of debt that you have compared to the amount of income that you bring in. Now, as a generic thing, we don't want to see more than 50% of your housing expense. We don't want to, I can't even talk. We don't want to see more than 50% of your income go towards your housing expense. And usually it's not even that high. It's about 40%. You don't want to see more than about 40% of your monthly income go on the housing. The 50% is actually your back end. So that back end means like your housing expense and any other debt like credit cards, student loans, things like that. You don't want to go over 50% for that. Your housing expense, you want to stay under that 40% range. Part-time income can be used, but it can only be used if you, again, have 2 years of consistency. You can't have a part-time job for 1 year and a full-time job for 2 years. I can only use your full-time income. You'd have to stay on that part-time job for at least 2 years in order for me to take in consideration that income. And then finally, any income outside of employment income needs to show a 3-year continuance. What that means to you is that, let's just say you're getting any child support, or you're getting spousal support, or whatever type of additional income that you have that is not from your employer or self-employment, you need to be able to prove to us that you're going to continue to get that for 3 years. So typically there's documentations that involve like court orders, divorce decrees, things like that. That's what we would need to see as proof of income. Everybody's situation, again, is unique. So depending on what your specific situation is, I will tell you exactly what documentation you need. But keep in mind, you have to have 3 years to continue that income in order for me to use it. All right, let's go ahead and get into the next slide. Okay, guys, I get it. This is a lot of information and you may not be there. You may not have the credit. That's fine. You may not have the down payment. That's fine. Do not worry. We got you. So we offer a credit analyzation system that helps you get your score up. It's called a rapid rescore. So if you're pretty close to where we need you to be, our credit analyzer will tell us what steps we need to take to get you exactly where we need you to be. Those typically work best when we're looking at down payment assistance or you want to get a better interest rate, things like that. Let's just say we use the credit analyzer and we can't get you to where we need you to be. That's not a problem because guess what? We can refer you out to a credit repair specialist and they will take the time to get you exactly where we need you to be and then follow up with you within 4 to 6 months. So just because you're not ready now does not mean you shouldn't start getting ready. And believe me as a loan officer, your realtor, Zandria, will definitely hold you accountable. So we will definitely be consistent with follow-ups, maybe once or twice a month just to see how things are going, to see what has changed, where you're at, and get you where you want to be. So do not worry if you're not ready. We can definitely help get you there, okay? All right. And then finally, I wanted to go over assets. So when we're looking at assets, verifiable assets for your down payment, let's go ahead and start with the no, because a lot of people assume that we can use cash deposits. Any assets need to be verifiable, meaning we have to source wherever those funds come from. So typically we're looking at your bank statements, your checking, savings account. If you have a 401k, you can always borrow funds from the 401k to get your down payment. So always check with your employer there. A lot of you have a 401k and may not even realize how much money's in there. So you can get your down payment from that. Gift funds. Gift funds are something that, let's just say a friend or family member is going to gift you the funds for your down payment. All they need to do is write a letter that we will print out and have them sign with the information needed, and they can just get that back to us. And then also if you have any assets like IRAs, I already said 401ks, but like IRAs, things like that, those are sources of verifiable assets. Again, no cash. And be careful of your transactions back and forth in your accounts, because once your loan is in underwriting, any transactions or cash deposits will need to be verified. So stay clear of those for at least 2 months because your underwriter will question those, okay? Any large deposits will need to be sourced. So yes, again, I understand this is a lot of information, but I want to make sure that you are prepared. So I'm going to give you information overload. You'll get a copy of this recording. Just watch it on a replay, repeat, and call me or your realtor if you have any questions. All right, you guys? All right, so how much home can you afford? So there's a trick, you guys. Let's say a husband makes $50,000, and we're going to have not just the husband on the loan, but we're going to have the wife. So husband and wife. So husband makes $50,000, wife makes $50,000. Now the total income is $100,000. The trick is to take the total income, $100,000, divide that by 2, and that gets you how much home you can afford. You just add a 0. So $50,000, add a 0. Guess what, guys? I can borrow a $500,000 house. This is if you don't have any debt. So if you have student loans, auto loans, things like that, you can't calculate it like this, but you'll have a general idea. You would just take off some of that because the additional debt that you currently have, okay? Next question, how long does it take to get a pre-approval? So I can do a pre-approval, I would say give it up to 72 business hours, but typically it takes about 48. So that means that I'm gonna do your income verification, and then once I verify all of your income and all of that, I'll send it over to an underwriter to get a second opinion. Now the underwriter's opinion matters more than mine. I'm your loan officer, I take the application. The underwriter is going to make sure that we're gonna get our money back, and they do just that. They will look for anything that will prevent the loan from being approved and let you know that you need to provide documentation here, here, here. Now, the underwriting process may seem like a bit of a headache, but believe me, if you do the work up front, when you are ready to make an offer on a house, everything should be peasy breezy, okay? And then final question, and I already answered this, but what happens if I don't qualify? That's fine, because you don't have to be ready. If we have a conversation and we feel like you're not ready, or we don't have the income, assets, or the credit, it's okay, because we will create a personalized plan for you. Thank you so much for watching the presentation. This does conclude our first-time homeowners webinar. Now that you've completed the webinar, I wanted to let you know that you are now eligible for a no-cost customized plan to get you into your own home. Again, this is at no cost to you. What we will do is look at your income, we'll look at your assets, and we'll look at your credit. We'll make sure that we get you on track to home ownership. Again, if you're not there, don't worry. We're more than happy to help you. Thank you so much for watching, and click the link below to get started. Bye.